Hey, everybody. Welcome back to the Trading with Ashley show. I've gotten a few questions about why my steering wheel is on the wrong side, and it's only because it's a mirror image. And I've gotten a few other questions about why am I filming in my car? And it's for a couple of reasons. One, the sound quality is much better. And two, there's less distractions. And three, it's kind of personal, but if I make mistakes, I've got such a busy household, and it's so hard to talk freely with people running in and out, and then if I make mistakes, I hear snickers and laughs. So, anyway, this is just a smoother video, but I'll still do videos in other spots, but wanted to answer that question. Now, I thought this would be a helpful video because I am definitely brainstorming, trying to come up with ways to help my community with a variety of different trading scenarios. And so this is to help them, but to help you as well. I know the natural question that you have in this crazy environment with the major drops that we've seen is it a great time to buy or should I sell everything and go to cash? And so what I'm going to do in this video is to help you at least collect your thoughts so that you can make a rational decision because trading can be very emotional and I don't want any of you to make a rash decision to only regret it later. And so, what I thought we'd do one, let's look at past crashes and what the recovery time was once the crash took place. And then that will help us better determine what course of action we take for our plays. So, here's what we're going to do we're going to go over that. And then I'm going to take you through three common trading scenarios you might find yourself in. So, first one will be we're going to look at stocks themselves. If you actually own the stock or the ETF, or if you're interested in the stock or ETF and you're not sure, do I sell what I have now or do I buy new shares if I don't have it or if I want to average down? So that's going to be scenario number one. Scenario number two that we're going to look at will be how do we handle purchased leaps? And so a lot of us have leaps because we saw, I have been sharing in several of my videos how you can maximize your buying power if you use the leaps instead of the stocks themselves. But the risk to that is if the market pulls back and these leaps start to lose value. Well, do they have time to recover? Will they recover? What do I do with them? Or if you're on the other scenario and you're like, is this the time to buy leaps? Is this the time? So I'm going to take you through both of those scenarios. If you already have leaps, what to do with them so you can decide. I'll give you some scenarios. Or then if you want to get into leaps, is this the time? So we're going to talk about that. And then the third thing is sold puts. So, how do we handle sold puts? Either those that we already have, maybe it's breached your strike price, maybe it hasn't, maybe it's a further output. We'll look at that. And then, is this time to sell puts? And if so, what strike price do we choose? And so, I'm going to take you through that scenario. So, this is going to be an information packed video, but hopefully, it will help at least give you some guidance or direction because you can only make that decision, but this will help you frame up your thought process. All right, let's go tackle all of this together now. I pulled a little research for you on the NASDAQ, and I thought we would look at this one because most of you that are interested in selling options, you have a tendency to lean towards the tech stock, and that's the NASDAQ. And so I thought it might be helpful to see what has happened with the NASDAQ through the years and what it took before they recovered. Because as you are trying to gauge what you do, especially if you have an important dynamic on the horizon, let's say you had planned retirement or you have a project that you were planning on using those funds for, or if you've purchased leaps and they have an expiration date, you kind of want to have a good understanding of when we might get back to the level where we were before this big drop or when we might get back to all-time highs. So the first one is the dot-com crash, and this was very concerning. I actually lived through this. I remember I was working for corporate America at the time, and I remember thinking that seeing your 401k literally be split in half, how disheartening that was. But did you know that it took 15 years to get back to an all-time high, but the pre-dropped level only took 6 months to get back to that. So you were starting to catch your breath at that point 6 months later. It was a 36% drop. Then the financial crisis of 2008, that one was pretty dramatic as well. It was a 25% drop in 2 months. and it took about 5 months to get back to the pre-drop level, and then all-time recovery took 4.5 years to get back to the all-time highs. Then the COVID crash. This one was a lot quicker on the recovery, so it took a 20% pull down in 1 month. That was February to March timeframe. Within 2 months, we were back to the pre-drop levels, and it only took 5 months to get back to all-time highs. So that was truly that V-shaped recovery that many of you were a part of. And then when you look at the 2022 bear market, which is our most recent other than what's happening right now, in 16% drop in 2 months, and it took 7 months to get back to the original level, and then it took 18 months to get back to all-time highs. Now, the current situation, it is looking like we will be suffering another drop tomorrow based on what the futures are telling us. We've already taken a 19.4% hit, and it's estimated that in about 3 to 6 months, we should be back to the level prior to this huge pull down, but it could take, another 12 months, potentially even longer, to get back to all-time highs. So this is going to be helpful for you. You may want to screenshot it as you are looking at some of your positions and trying to determine what you do with them moving forward. Now, when it comes to stocks themselves, and if you actually own some of these stocks and you're wondering, should I get rid of them? Will they ever come back? This will be a way for you to tell. So I am looking at NVIDIA, and I am going to the Analysis tab on Yahoo Finance. You can find this information in a variety of forums, but this is the one that I use. And the first thing I like to look at in these situations, or I like to look at the health of a company. And in this situation, you can see that NVIDIA at this point has been a really healthy company. Their revenue has steadily increased, and so have their earnings. And that shows that it's got staying power. They've got good cash on the balance sheet, and they can withstand a storm like now. And so these are the type of companies that will come roaring back. And once the money on the sidelines decides to get back into the market, this is the type of company that someone would want to start buying right away. So you could sell if you're at a loss, but then you are locking in your losses, and then you're going to be scrambling to try to catch the bottom. So I think something that you might want to consider is if you don't have your full-size position, and typically I like to say people should consider only having about 7% in high conviction plays, 7% of their portfolio, then you may consider dollar cost averaging on the way down to lower your average. Right now, we're looking at NVIDIA. Now at market close, Friday, it was at 92. I'm anticipating we'll be down further tomorrow. But what I like to do is I like to look at the 52-week high, and that was 153. So if we get anywhere around that 75 mark, we would be at 50% of the 52-week high. And that's a good point that I like to actually start adding to my position, because eventually, let's say in 12 months, we get back to the 52-week high, you have literally doubled your money in a short time frame. And even if it takes another year and a half, 2 years, still, that is very impressive to be able to go from $75 back up to $150 in that short time frame. So that's how I like to consider how heavy I should go in on any position. So if it's a healthy company and you see about a 40 to 50% drop from the 52-week high, that's when I personally go in heavier. Now let's discuss Leap's call options, because many of you may have them. It's a more efficient way to have exposure to a stock, but they can go to zero. And so you want to look to determine if your stock or your ETF has a chance for recovery. So for that, I like to look at an option calculator because it looks at a lot of different factors that will help me make that decision. In this situation, this is actually a call that I had. It's 460 call on the QQQ. It was purchased several weeks ago. At the time, the QQQ was trading much higher. This one expires in June of 2026. So one thing that you can do is you can look and clearly see what it would be if you were paying for it today. But I paid a different price. I paid a lot more. So what you can do, you can go in here. This is Option Strat, and you can click on the symbol right here, and you can change the price. So right here, this is what it's trading for now, but I actually paid $59 for it. So having that in here is helpful because now all of these figures that I'm looking at are reflected based on my purchase price. So in my situation, what I might want to consider is thinking, okay, if we do go back to the point that I purchased this, if we get back there in 3 months from now, then where will we be? So when I actually made this purchase, we were closer to around 475 on the QQQ. So I can look at this and I can go down the line and say, okay, here we are right now in April. So I want to look at May, June, July. Let me consider July. If I were to get back to that 475 area, it looks like I would be at a break even point or just a little bit green, $168 in profit based on my purchase price. So for me, this might be worth holding if I feel like we can at least get back to this point. And this will help any of you that are in a similar situation. Now, there's lots of option calculators that you can put in your purchase price, but this is just how I do it and how I gauge it. But if I had a leaps that was expiring, let's say in the next 4 or 5 months, because I had purchased it quite a while back, I could also look at this and determine if the QQQ gets back up to my purchase price by that date. Maybe I don't have the luxury of it a lot of times. So let's say maybe September 15th was my expiration date. Well, if we get back up to September 15th, it's still at a loss, even if we get back up to the purchase price. So in this situation, I might consider doing something different depending on how much is left in the leaps. If you have at least 50% left in the leaps call option, at that point, you may consider just taking out your money and using it for another play once the dust settles. Now, for those of you that have sold puts that are underwater, meaning your strike price is higher than the current trading action, there's a few things you can consider. So let's look at this one. This is an Amazon one that I had put on, and it's got the 195 strike. Well, currently we're well under that. We're at 171, and we could go down even further. Now, this has a little while before it expires, so it's probably fine. But if I wanted to take an extra measure of safety, I might consider going ahead and rolling this down now in case we continue to drop. At least I can push this out further in time. So let's assume that Amazon in the coming days gets to around 150. Well, at that point, I may just decide to go ahead and purchase Amazon. If you have the cash waiting on the side, may go ahead and get my position set, buy my 100 shares, and then I want to go ahead and take action on this now. So if I had the 195 strike, I definitely would want to pull this down a little bit more for a credit. So let's determine how that may be a good situation. If right now I were going to buy this back, it would cost me $27, which is showing a loss right now because I was only paid $453. So I'm going to have to pay back that $453 plus another $23.45 to get out of this trade. So if I'm going to sell a new trade, I want to make sure that I'm getting more than $27.98 because this is what it's costing me to get out of the trade. Now, $195 is a reasonable amount in a healthy economy, but we're not in a healthy economy right now, so let me go and see what I can find. When you're rolling a trade, you want to consider going out to a time when you think the dust has settled. So for me, I'm going to shoot for the end of the year for 12/19/2025. I'm hoping that some of this drama would have blown over. The VIX would have retreated at that point and we'd be in a much better situation. So let me do this. I'm going to go down and let me try to, I probably can't find a strike that is close to where we are now, but maybe I could meet in the middle. Let me look at like a 180 because if we're trading at around 170 now and this is 195, once we have a rebound, this could easily come above 180. So that's kind of how I look at this. So this is a put, and then I am going to sell to open a new one. Let's see what the price would be. So at this point, it's still a debit. Now, this is still a decent trade. I could decide to pay $2.48 to go ahead and put on this trade and pull down my strike price. But I really do want to get a credit. So I could do one of a few things. I could stick with a higher strike price, or I could go a little bit further out in time. So let's look at both of those scenarios. If I change this to 190, so a $5 better strike price, that dramatically changes the equation. Look at this. Now I'm getting a credit of $300 to make this trade. So that might be an option I consider. Or if I really wanted to stick with that 185 price, then I might change this to, let's see what it looks like in March of next year. Okay, that changes the picture dramatically as well. Look at this. I am getting a credit at this point of $8.30. So this is a lot better situation for me because I will have to wait quite a bit longer, but I'm getting compensated for waiting that much longer. So this may be the trade that I decide to make if I am going to kick the can down the road. I hope you found this thought provoking and it gives you a little bit more power. When we are trading, it's really having options is the name of the game. It's being able to mix and match your strategies and be able to maximize the opportunities in front of you and being nimble. And so this is part of being nimble. So I hope that helps you. If you could do me a favor and just share this video with one fellow trader, and that would really maybe help them so they can frame up their thought process and save this video. This is something that you can use time and time again because this will not be the last pullback, drawdown, crash that we are going to see. It is a part of the market. It's what makes the market run, quite frankly. All right, I am going to leave another video for you that might help you through these turbulent times. I'm going to leave that video for you right here. Remember, if you're with me, Trading with Ashley, there is no trader left behind.